morning. You're watching Business World Live. I'm Danny Laurel.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day, Friday. The Philippine economy grew at a faster pace than initially reported in 2021.
As unemployment remained unchanged in February, NEDA pushes for a nationwide shift to Alert Level 1 to create more jobs.
Fresh data from the Statistics Agency, the country's manufacturing output climbs in February. Exports also see an increase in the same month.
Bloodbath at the local bourse yesterday, all counters ending in the red. The bellwether index fell below the crucial 7,000 level. We begin our broadcast with the domestic economy growing faster than initially reported in 2021.
Fresh data from the Philippine Statistics Authority show that GDP expanded by 5.7% last year. The upgraded figure is slightly higher than the 5.6% growth reported back in January. This is 2021 fourth quarter GDP was revised to 7.8% from 7.7%. Major upward revisions were recorded in construction, manufacturing, and mining sectors. GDP adjustments are regularly conducted to reflect the updates of pertinent data. These changes are also consistent with international practices on national accounts revisions. For 2022, the government expects the economy to grow by 7 to 9%.
And here's another set of data from the PSA. Manufacturing climbed to its highest level in 5 months in February. This is on the back of increased economic activity due to the eased restrictions as well as favorable base effects. PSA data shows that factory output jumped 84.3% year-on-year in February from the revised 17.1% the month before. The February figure was a turnaround from the 43.9% decline recorded in February of last year. It was also the highest year-on-year growth in 5 months or since the 122% surge in September of last year. Now, on the trade front, exports rose by 15% in February. This was a turnaround from a contraction of more than 1% in February last year and also higher than the 9% growth recorded in January. A Bloomberg poll showed that economists had expected exports to grow by 10% in the same month. Meanwhile, imports decreased by 20% from more than 27% in January. This brings the trade gap to an annual increase of 30.3% in February, narrower than the deficit of nearly 64% recorded in January.
NEDA is backing the proposal for a nationwide shift to Alert Level 1 to boost employment figures. The agency explained that increased mobility and easing of restrictions led to significant employment creation in February. This as the PSA reported that unemployment steadied at 6.4% on a monthly basis in February. Now, as of April 1st, 79% of the economy has been placed under the most lenient classification, Alert Level 1. However, NEDA Secretary CHUA also warned that the country cannot reap the full benefits of shifting to Alert Level 1 without resuming face-to-face classes. Okay, loads of economic data today, Jess. There, good thing we have on the show Robert Dan Rosas to help us out. He is the Assistant Vice President and the Chief Economist of Security Bank. Good morning, Sir Dan. Thank you for joining us today.
Good morning.
All right, sir. Now you have calls, at least from the NEDA, to shift the entire country to Alert Level 1. That's to further boost employment figures. How much of a boost is this going to give the labor market? Numbers steady, of course, in February. How would a shift help improve our labor numbers?
Well, you also reported earlier, the increase in the manufacturing side, So that also plays out with that shift to Alert Level 1. If I'm not mistaken, I think around 79% of the country is already in Alert Level 1. So that allowed more people to rejoin the labor force in relation to unemployment. And the possibility of more lenient levels for most of the country should really drive the unemployment level down. As such, we expect, like likely at the end of the year that the pre-pandemic average of around 5.5% will already be reached. No? So the unemployment rate, despite remaining unchanged from the previous month, in absolute terms, it was actually the lowest share of the unemployed to the total labor force, no, in over 2 years, or since the pandemic started. So the size of the labor force actually expanded by around 2 million, and that translated to a higher participation rate of 63.8. No? So the reopening theme is playing up very well in terms of the manufacturing side and also the unemployment side.
Now, Sir Dan, how much of the unemployment numbers returning to pre-pandemic levels is contingent on whether or not face-to-face classes will go full swing? I mean, it's very interesting how Secretary CHUA pointed out the need to actually return to face-to-face classes in order to allow more parents to go back to work.
Yeah, that's actually an interesting hypothesis, though, that the labor force could likely improve, no, if the face-to-face classes begin once again. I'm sure they ran their numbers, no, and there could be some empirical basis to it. No, so, but it actually makes sense. I mean, there are a lot of parents who were unable to continue working because of the need to be able to supervise their kids at home. No? So there could be some logic to it, but I don't think it's going to drive the unemployment level improvement by much. No? But it should help. It should help at least.
Sir, reacts on the latest econ figures. You already mentioned the PMI, so 3-year high, they're expansionary, and then we also have the exports higher than economists had expected, 15% year-on-year. Is this just base effects? Is this already signaling growth, particularly in production, in output of the economy?
I think it's signaling growth at the very least. The PMI is closely correlated with GDP growth. No? So directionally, if the PMI remains in expansion, we should expect GDP to go up as well. No? I think the latest figure that we have in terms of it being correlated to it is around 90%. So that's a very strong relationship between the two. No? And it's a very good leading indicator as well. So with the PMI remaining in expansion, we also saw well, it's validated by the manufacturing output volume, no, in value. So it's playing out well. We're still seeing the expansion taking place. The recovery is slowly getting there, no, despite the headwinds that we face because of inflation.
Sir, is this a sustainable figure, or is this just, a reaction because we were in lockdown, so the production had to catch up? But will we be seeing continued expansionary PMI and continued exports jumping moving forward, especially with the global issues happening and some fears of a recession also globally?
Yeah, well, the global thing is one of the strongest headwinds that our recovery is facing at the moment. No? But I think it should remain expansionary. Capacity utilization isn't at pre-pandemic levels yet. No? So if that picks up, unemployment will also go down with it, no? Because the sector is one of the largest employers. Second is that there's still some pent-up demand to supply with. No? So in terms of the manufacturing side, there's still that avenue to go through. No? So we did see, with the revision of the GDP to 0.1 percentage points higher, no? That's still showing us that the recovery story is just beginning. So there's pent-up demand, as we saw from the third quarter of the GDP last year, driving the recovery, no? And consumption being 75% of the economy. No? It's still not at the pre-pandemic level yet. No? So it's slowly recovering. The suppliers, meaning the production side, will be should be able to fill up the demand, no, that's slowly coming up. No? So that should remain expansionary in the months ahead.
Okay, sir, how much of a drawback to the recovery story are current inflation levels? How long do we expect this to stay elevated, or have we seen it already peak, and is it going to cool sooner rather than later?
So, well, right now the risk is that commodities contagion. So in previous episodes of high inflation, um, uh, the pressures were mostly cost push as they are today. However, the cost push levers now are much different than in the recent past because of that global commodities contagion. Clearly, the key risk is the possibility that world commodity prices stay elevated for a prolonged period as a function of the Russia-Ukraine conflict. No? So that pressures inflationary tendencies. It could force the BSP's hand to do an earlier than expected rate hike. No, because of the risk of losing its grip on inflation expectations. So inflation actually eats up the consumption side. So that will affect well, we're not really anticipating a regression towards a negative path for growth now, despite the significant headwinds brought on by inflation because of higher commodity prices. But rather, it's just going to slow the potential than initially expected because of the effects of inflation to consumption. So that could dampen recovery, although it's not going to derail it. That's why we're seeing lower GDP forecast now from a lot of counterparties. But we're still seeing growth. So there's that.
Sir, what level of inflation are you comfortable with before you think the BSP needs to act?
Well, I think it's right now it's averaging. Well, their forecast is around 4.3%. So if it averages above that, no, so that could also be a signal to them, or we could expect some signals already of the possibility of them doing a preemptive hike to actually control inflation. Another key thing is to watch out for is core inflation. No? There's no official figures yet because of the rebasing. But that will be a very important metric to watch out for because that will show us the bleeding of the inflationary tendencies towards the core side. No? So that should show the effect towards consumption rather than the more volatile components of oil and also food.
Sir, will that happen by the end of the year? The tightening?
Probably second half. No, they've been signaling by the second half. No, our expectations around 75 bips of so that's probably 325 bips hike. Well, they said second half of this year. No, but actually the window is closing because. Well, we have April, which is a non-meeting month for the Monetary Board, and then you have July as well. No? So if they're going to act, that means if they're going to act according to their timetable, that means that they have to begin at around August. No? And by that time, a lot of things could have happened already, no? Assuming that that the conflict gets drawn out.
Okay, earlier we reported, Sir Dan, about the 2021 GDP being revised, but how are things shaping up for the country this year? At what level do you see us growing, and how much of a risk are we looking at here, especially with low vaccination, or with vaccination take-up slowing down at the same time you have concerns over a new variant?
Well, like I said earlier, the reopening theme is playing out well with that improving mobility because of looser curves. You have higher vaccination rates, no? Despite the fact that the booster levels seem to be plateauing. And we have better PMIs now. So as mentioned earlier, we're not anticipating a regression towards a negative path for growth. Despite significant headwinds, a slower potential growth than initially expected could take place because of inflation's effect to consumption. dampening recovery, though not derailing it. As such, we expect GDP growth to be at 6% this year. And with base effect and also looser curves, the first quarter growth could still print in the 7% or higher area so far. No? So first quarter shaping up to be very good. Second quarter, a lot of the risks coming out of the conflict could likely get reflected in the data. And also, despite what we're seeing already, we're still in the middle of a pandemic. No? So there's still that risk of the virus evolving towards a more dangerous variant. So far, so good. No? We're not seeing it yet. But the risk is still there. No? So those have been actually factored into the GDP calculations as of late.
Okay, so reopening play still ongoing and well on track. Some key risks, of course, on the table, but hopefully we've learned enough to be able to manage them this time around and keep those numbers optimistic. Thank you so much for those insights, Robert Tan Roses, Chief Economist of Security Bank.
Thank you.
Now, coming right up, we'll check how the local bourse is performing on the last trading day of the week after it plunged below 7,000 yesterday.
More of that and other stories when Business World Live returns. Stay with us.
And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Danny Laurel.
Okay, three key themes of 2022 year-to-date: Fed tightening, Chinese COVID crisis, and the Russia-Ukraine war all coming together this morning in an unfortunate reminder that we're still in the thick of volatility. Dan, of course, is here to tell us more.
Exactly, Jess. Second quarter na, same story. Global equities having slid on the back of the Fed. They had released, the meeting minutes there. They said that they will be tightening sooner rather than later. You've also got China. How are they handling the Shanghai lockdown? They've reported more than 20,000 daily COVID cases. And this one, just U.S. officials warning that the war in Ukraine may last for weeks or even years. And take a look at my terminal here. The futures of the Wall Street indices are in the red. And yesterday, Europe dramatically down as well. Asia is a bit of a mix here. And I did want to mention one specific issue, which is the coal story. I'm going to pull that out for you. It slid a touch here, but you can see that major spike in coal. And now coal imports from Russia, this is the first time that the EU has actually targeted the energy reserves and given sanctions in terms of importing that. That also includes a ban on most Russian trucks and ships entering the EU. And this was signed off by the bloc's diplomats on Thursday and was announced by France. And let's take a quick peek at our major provider or producer of oil here. And that is, of course, Semirara. I just actually got that out. Let me pull that back in, but that is of course Semirara, and they have been jumping year to date on the back of all of these developments. Of course, they are our biggest coal producer. We also have Coal Asia, which is another producer here. This is owned by DMCI, and you can see the jump in prices of Semirara this morning. That is up by 1.8% to 31 pesos and 55 centavos on the back of that EU coal ban. And let's take a quick peek at how our index is doing, and the big movers here finally gaining some ground, but you can see which ones are really the ones standing out here, and that is the mining and oil counter, always up by 1.4%. But finally, financials and properties also enjoying. But I do have to say, we have to take the sea of green into consideration. After we fell by 2.6% yesterday, we are still just up by 0.7%, so still far from what we were even 2 days before, and still settling in at 76.77, so still well below the 7,000 psychological levels. And this, of course, happening as net foreign selling grew to close to 1 billion pesos yesterday, Jess.
The central bank wants to showcase its tightened regulations on registration of money transfer services as it aims to exit the list of countries that are under increased monitoring for dirty money risks. The country is hoping to convince the global financial crime watchdog Financial Action Task Force that it is effectively implementing tighter measures against money laundering and counter-terrorism financing after the Philippines was included in the gray list in June last year. The Bangko Sentral also aims to focus on the effectiveness of targeted financial sanctions.
Taxes collected from POGOs dropped to nearly 4 billion pesos last year. That's a 46% fall from the tax collected from POGOs in 2020, despite the passage of a fiscal measure covering their activities. Recall that last year, President Duterte signed a law legalizing the activities of POGOs in the country. And with this law in place, Finance Secretary Sonny Dominguez expects the BIR to raise around 76 billion pesos from POGOs this year and next year. That would be a huge jump from last year's dampened collections.
On top of the low collection from POGOs, a lawmaker warns that authorities are also losing 26 billion pesos to the fake tobacco trade. Official records from the BIR and the Customs Bureau show that the government has forfeited an average of 1.7 billion pesos in taxes due to the illicit trade of cigarettes. But PBA Party List Representative Coco Nograles said the government loses more to the production, importation, and distribution of fake tobacco nationwide. Nograles, who heads the House Technical Working Group on illicit tobacco, said about 13% of the cigarette market in the Philippines falls outside state monitoring.
Meanwhile, the monthly household subsidy for poor families is set to increase from 200 pesos to 500 pesos by May. That's according to another congressman. House Ways and Means Chairperson Joey Salceda says the distribution of the increased subsidy will definitely push through as the executive department has found unused cash balances to fund the measure. Salceda notes that the DSWD will oversee the household subsidy and that the agency has requested for an exemption from the election spending ban. The Albay representative adds that fuel subsidy for drivers under the Pantawid Pasada program will also continue to head off any fare increases and second-round effects from the oil prices.
All right, some good news there to end the week with. Again, that's a first look into the business day this Friday, April 8, 2022. Join us again Monday next week at exactly 9:30 a.m. You can also catch us on Signal Play. Register for a free account now at www.signalplay.com and stream One News Live anytime, anywhere. I'm Jess De Los Santos.
Jess, it's the end to a long and volatile week. Happy Friday and enjoy the weekend. I'm Danny Laurel, mask on. Wash hands, stay safe, Philippines. We are One News.